TARP and TALF, if you can remember back before the QEs began, rescued the nation's biggest banks, plus AIG, plus General Motors, but it didn't put the economy back on a sustainable growth path. So QE1 was implemented to buy bonds, including mortgage-backed bonds that otherwise had no market. And that was designed to free financial institutions so they would lend money so the unemployed would become employed. That would then continue, well, at least they would prevent them from losing their homes to foreclosure. And in fact, the hope was that they would start to whittle down the immense overhang of those homes for sale. That was all the intent of the early stages of QE1. Stock market and junk bonds both jumped, and unemployment, well, they both jumped starting with QE1, but then unemployment and the foreclosures remained near modern day highs, so QE2 was implemented, and the stock market and junk bonds jumped again. But now we're coming to the end, or the scheduled end, of QE2, and let's look at where we are now. Have the QEs, at least cumulatively, improved the picture to the point where we're in a self-sustaining type recovery? Page 11 shows you that bank lending is increasing. And that's generally considered a good thing, because typically there is very little growth in an economy unless there is a growth in lending. At the same time, it's a bit of a mixed blessing, however, because given the immense amount of debt that's already accumulated, any additional lending is simply adding to those debt numbers. This graph is a lot like a great many other graphs of the economy, and I didn't put a whole series of these in there. They show a very good growth rate off the bottom. So if you were to look at the rate of growth, you'd say, this is a terrific recovery. But if you look at level, you are not in a good position, despite great growth. So there's a big difference between growth rate and level of activity. And here you see it is below the levels, going all the way back for more than a decade, even of the depression levels, recession levels of the 2001-2002 time period. Counterbalancing loan growth, however, is a large collection of consumer-related problems. If you look at page 12, we have near record housing vacancies. That's not a surprise to anybody. This shows the vacant units as a percentage of housing stock. And it shows that we're currently at 7.6% of U.S. housing stock. Way, way above what at least is considered normal on this graph going back into the 1970s. And so many vacant units continue to put severe pressure on home prices, which you see over on page 13. Home prices falling again. This is the general price level. As figured, this is CoreLogic Home Price Index. And down here you have the rate of either increase in home prices or decrease in home prices. And you can see we clearly have started to recover with some of the tax help and so on, and now we have started to descend again, and home prices are, on this study, 7.5% below where they were last year at this same time. Forecasts of a housing bottom have been wrong for more than a year, despite a huge flood of new money from the Fed. And a major part of why real estate is so weak is the stagnant employment situation shown over on page 14. In the upper left corner here, This is U.S. payroll employment. This is a number you want to see grow. I mean, so this, you can see it's been growing here in the 90s, then a little dip with the first recession, growth into the mid to latter part of the decade, big decline, of course, with this most recent recession. And now for the last 2 years or so, it's been growing, but growing very anemically. We just aren't seeing any real pickup in hiring. And that's been the biggest problem that the Fed and others are trying to solve. And the unfortunate thing, if you look over on this side, you will see that whereas these are unemployment claims. These are first initial claims for unemployment insurance. So you want this number to be going down. And of course, it did start going down as we got further away from the recession. And so we're not getting as many people that are making unemployment claims. We just aren't seeing an awful lot of people added to the rolls. And unfortunately here, we see, and this is a 4-week average, not just a week-to-week, you see that the unemployment claims have hooked back up again. Susan, could you please bring me another of those really hot waters with lemon in it? It's like hot coffee water, if you would. Thank you. And compounding the problem is what you see here at the bottom. The working age population continues to grow, which means more and more people need work. And it's one of the reasons why, if we don't get a substantial increase in new jobs, we aren't going to see any decrease in the unemployment rate, which is right now at 9%. And if you look at the expanded unemployment rate, what they call the U6, which is basically unemployed and not deliberately underemployed, people who would like to work full-time but can't get full-time jobs. And that number is up near 16 to 17%. So that's one person out of roughly 6 in our economy who wants to work, who is either unemployed or unwittingly and unwillingly underemployed. And that has left consumers very uncomfortable, as the next page shows. Even though the stock market and the economy have bounced back, consumers' attitudes have not. And what you have here, and it shows the Consumer Comfort Index here at the top and its various components down here. And this goes back into the 1980s, so we're looking at a quarter of a century thereabout. Thank you very much. Thanks. Okay. So it's near its low for a quarter of a century. And unfortunately, you'll see most of these are just hooking down again a little bit. We're not even getting a lift out of in the consumer comfort area. And it's true of the various components. Here they're looking at the state of the economy. They're looking at personal finances here. The graphs look the same. And this is buying climate. Nobody looks very aggressively ready to buy, and you can even see that's hooking down again quite a bit. So, and then small businesses, over on the next page, which are the main source of job growth in a strong economy, remain very pessimistic. This is a survey that just came out last week. National Federation of Independent Business, I believe it, if I remember what the acronym is. But it's the NFIB Small Business Optimism Index. And you can see it plunged tremendously in this last recession. And again, like we saw in the earlier graph, we've had a substantial increase in optimism from the bottom to where we are today. Unfortunately, again, it's kind of hooked down. You want to see this rise, you don't want to see it come down. But even with that significant growth, if you look at the level, you will see it's below even recession levels of optimism. It's way below the typical optimism in an expansion. And we've been in an expansion for 2 years. It's a remarkable level of pessimism. And I think a good part of this is that we look around We see houses empty. We see our neighbors out of a job, or not even willing to look perhaps for a job because they don't feel there's any real prospect of getting one. And businesses in this survey, apparently, even though their profits have gone up, they're not willing to say, I'm willing to take the next step and bring on more employees. And that poses a very, very serious problem to our entire economy. Page 17, well, I was saying before that the economic indicators, both domestic and global, have kind of rolled over, as we saw on this is an optimism chart, but we've seen, if you were looking at a variety of economic graphs, you see also that tendency. They've been rising, and most recently they've started to roll over. And they're either experiencing declines or at least slower growth. What we have over on 17 is a picture of copper, and I show copper because copper is used in almost everything. When you go around the world, if you're going to, almost anything you build, you use copper. And so copper tends to be a reasonably good measure of economic well-being. And it's also considered to be a pretty good forecaster of business prospects. And copper prices rose dramatically over the past 2 years, largely on the strength of the demand from emerging economies. Now, for whatever the reason, and it could be temporary, we saw a decline in here when the Fed stopped QE1 and everything started to decline. Now we're seeing another rollover, even though the QE2 is still going. But every time you see copper roll over, you at least, it's a little bit of a red flag up there saying perhaps we have a problem yet to come. Another cautionary tale is told on the next page. It's rare that we see an economy growth along without a vibrant, profitable financial system. And this graph shows how the financial sector has performed relative to the overall Standard & Poor's 500. So it's not the measure just of the financial sector itself. It's a measure of the relative progress of the financial sector compared to the S&P 500. And you'll note how it began to decline in early 2007, and that turned out to be a very accurate forecaster of the very serious market collapse that began in late 07 and continued on into the beginning of 09. And many of these entities, as you know, were dead financial institutions, but for government rescue. So they survived through the largesse of government, and they recovered initially, and then they flatlined for a while. And now, even though the stock market has continued up, the financial sector has started to roll over again. Whatever that means, we'll know in retrospect, but it typically has not been a positive factor. You want a strong, vibrant financial system if you're going to have a strong economy and strong stock market. Because of the tremendous amount of new money that's been created, there certainly is a great concern about the potential for inflation to become severe. And I had intended to go into the inflation-deflation question in some detail. I note there isn't enough time to go into it in some detail, and that's my fault. I do an awful lot of preparation for these presentations, but I don't do much rehearsing for these presentations. As a result, I often don't have a good handle on how much time it's going to take me to get from here to there. And I find I'm cheek by jowl with a clock, so what I'm going to try to do is to spend a few minutes just hitting a couple of the graphs, and we'll go from there. If you look at page 19, you'll see at least the most commonly mentioned measures of inflation. The CPI is the one that, the Consumer Price Index, is one that most people pay attention to. And that is, at its latest reading, is at 3.2%. And that line is right here. It is now at 3.2% So over the past year,